Hello, hello, Josh Thomas, mortgage broker here in Utah. How you doing today? Hey, I hope that things are going great for you. Summer's just about to get underway for me at the time of recording of this. Don't know if you'll be watching this some other day, some other time. But in any case, wanted to go through some things, share some interest rates with you, as I like to start out most of my videos, just kind of sharing where rates are at, and well, my longer videos. And then I'm going to talk about actually being a loan officer. We're hiring. So I'm going to get into that and kind of show you a little bit about what this job's like and see if you know anyone that might be interested in it. It's a good job. Um, Great opportunity. So we'll go into that in just a second. I'm going to talk about credit quite a bit today. Credit still remains quite the enigma for most people, and there's a few super simple tricks and hacks to having phenomenal credit scores. And so I'm going to go through that. And then I think I'm going to finish up with a story from a client about a company called Homeserve, or maybe the lack of them. So I'll go ahead and get into all that. So first and foremost, let's go ahead and share my screen so that you can see where interest rates are at, and I'll kind of talk about them for just a moment. So as you can see, interest rates for FHA, 5.5, conventional, 6 1/8. I hear lots and lots of news about rates are elevated, rates are high. So let me ask you, do these rates look high to you? No, these aren't terrible interest rates. Are they free? What are the closing costs in this? You can see the APR listed below. These have got about a point and a half, in order to get these rates. It makes more sense in today's market generally for people to be paying a little point and a half to get to these rates. But they're about a 0.5% higher, I would say, if you don't. Um, but still, not horrible interest rates. Guys, if you think these rates are horrible, can I just take you back through memory lane for a second? I've been doing this for 23 years. Do you know what interest rates were when I started? In fact, what got me into the industry was there was a huge demand, huge. It was 2003, massive demand for lending. People were trying really, really hard to get better loans. Refinancing lines were out the door. They hired me because I was somebody to come help. They had refinancing rates or refinances locked for 90 days. So they would take an application and then they would tell the people, we're not going to talk to you for 90 days. Well, it was like 60 days. And people were okay with that. They were lined up out the door and down the street. And so that's what got me into the industry. The industry was busting at the seams and was hiring people like me. And so I got in. Do you know what that interest rate was that people were locking in for 90 days? It was 5.25. You see 5.25 FHA. So just like you see on my board here, just a tiny bit lower than that. People were clamoring to get that interest rate. So why has everybody got the messed up perspective now where, oh my gosh, rates are high? Well, it's because of the last 15 years, right? Now, what you don't remember about the last 15 years is the Federal Reserve has been manipulating the market in a major way. 2008 was a major crisis. When we had that, 2008 began, the Federal Reserve showed up in force and they ended up investing, or we'll call it stimulating. They injected over $4 trillion of non-existent US dollar bills. They printed the dollar bill and then they purchased mortgage-backed securities and treasuries with those dollar bills. And that injected $4 trillion of new money into the market, which helped all of us. It was a major help. And then they did it again, even more during the pandemic. And so that's what's brought interest rates so low. Those low rates stimulated the economy until we had inflation in 2022 and 21. And anyway, that's why everybody's got this messed up perspective. But the rates that you saw from 2009 through 2022 weren't real. Those weren't good interest rates. They weren't normal free market rates. But unfortunately, it's a very, very long time for a lot of folks. And so now we all got messed up. So anyway, that's where interest rates are at. Hopefully that's really useful and insightful, and you're like, oh yeah, that's awesome. I can't wait to get out there and buy another house now. So if you're a first-time home buyer and you haven't bought yet, these are great rates. You should be buying a house. If you are an existing homeowner and you've got 100, 200,000 bucks in your 401k or something, you should use that money to buy a rental property. Buying a second house is a really, really great idea. If you've already got three rental properties, then I probably don't have to tell you, you should buy another one. So anyway, they've been really great for me. So let's go ahead and kind of shift gears. Let's talk about hiring. A lot of people ask, well, you know what? Been asked of me many times over the years. I like to joke around with people when I'm taking an application. I like to tell people about the five agencies: Fannie, Freddie, FHA, VA, and USDA. Those five agencies write the loans for about 95% of all the loans done in the United States. But each agency has a rule book that's over 1,000 pages. In fact, FHA's is over 2,000 pages. And so that means that in order to be good at my job, I have to be fluent in 5,000 changing pages, changing because they like to update their rules all the time. So I like to joke around, but don't worry, we got AI. AI is yeah, makes it a lot easier to read some of these things a lot faster now. I used to have to pull open the 1,000 page and hit Control F. In fact, I still kind of do it a little bit just to verify things that AI is telling me and whatnot. But anyway, so I used to joke around because that sounds pretty intimidating, I think, to be fluent in 5,000 changing pages, except for all the CPAs and lawyers out there, right? Because you guys are, this is old hat for you. Well, if anybody that you know is interested in becoming a loan officer, becoming a mortgage loan officer, anyone you know that is a loan officer is looking for better opportunity, have them give me a call. It's time. I've decided I've reached a point in my career where it's time to train. So I've got one guy on my team now that we've got him in school. So there's schooling to get your license. It's about 35 hours. And it's kind of a bear of a test, I'm not gonna lie. But we'll help you get through. Well, I'm not sponsoring any of that. That's all on you that you got to do, but we certainly got some good resources for you to get your license. Once you got your license, though, just like most legal licenses, that doesn't do you t anything about how to be successful in this business. And so that's the schooling that we're supporting and sponsoring. We have schooling that's amazing. It actually cost me 4 grand to send somebody through that school, but it will put you with you will be hitting the ground running and making money as you go through the school. If you do the assignments and you attend the classes and follow through with the assignments made, you will be making money as you go. And then we'll continue to offer coaching throughout the rest of, my career, your career, until you decide to part ways with us or something. But what kind of income? That's one of the coolest things about this job. There is no ceiling. I have many colleagues that are making hundreds of thousands a year, and quite frankly, several that have broke into the seven figures. Seven figures, guys, it's crazy. Now, that's never been something that's overly impressive to me or interesting to me, so I'm not one of those guys. Never been rich and famous. Um, but as I talk about credit here in just a second, I will remind you a little bit of my own personal background because I think it's important. But yeah, it's been a great job for me. I've been able to be there for my kids, and I've been many times one of the few dads that are sitting there at the classroom stuff or the parades and the things that the kids do. And so I've been really fortunate to have this job. We've been working 100% remote for, well, since COVID, I guess. So what's that, 6 years now? Um, and so it's a great job. It's got some great benefits, great opportunities. I think one of the coolest things that I've really enjoyed about this job is the inside scoop, man. You meet hundreds of people and you see all walks of life. You see people highly educated and super smart doing super smart things, and it's just awesome to be able to kind of learn from them. And then you see other people not quite as smart, making not quite as smart of decisions. And if you're smart, you get to observe their mistakes and avoid those in your own life. And so anyway, it's been really cool. Lots of really cool people. You'll make some friends as you get to know many of them. And anyway, it's just a really great business. So we're hiring. If you know anybody interested, my ideal person, somebody high energy, can handle details, but maybe is a little bit more outgoing and social than they necessarily lean on the details. But they can handle the details. They can handle a checklist. They can pull it off with vigor. And then obvious, I would say ideally young, 20s, 30s, somewhere in that range, but young in their career for sure. So I'm looking for somebody who's a new loan officer, not somebody that's been doing it for 10 years. Um, my company's probably a good fit for them as well, but that's not what I'm personally hiring for. So anyway, so that's it. Let me know if you know anybody that'll be interested in that. Comment or share this video with them. Okay, so as we talk, I'm going to talk about credit now. I'm going to give you a couple of hacks for credit. Now, this is a really interesting thing because in just the last month or so, Vantage Score 4.0 is now being used in the mortgage industry. It's being rolled out. It's been piloted for a few. We basically have this coming from the top down. So we've got folks like President Trump telling his cabinet to go ahead and do things with this, and in those directions, one of those um, who am I trying to think of? The guy in charge of FHFA, Pulte. He came out and told everybody he's going to start using new credit. Now, this is an interesting thing. I'm going to draw a little tiny picture here, just for those that like history. You can skip past this a little bit if you want, but I think for those that like the little bit of background, this is cool. So, mortgage industry is funny because the mortgage industry has been locked in to old school credit reports for decades, right? So when I got in 03, we were using a certain credit report. And if you don't understand this, just like your cell phone has like iOS 1, iOS 2, or what was all the funny names that Alphabet and Google gave their operating systems for a while. Anyway, as you know, those changed. Well, credit reports are kind of like the same thing, and credit reports have updated, but not credit scoring software has updated, but not the mortgage industry. And so when credit rolled out, the mortgage industry built all these statistics and watched and all these millions of loans that were being done, and they saw, oh, if the credit score is this, then it's going to, this many of them are going to fail, and so we're going to charge this interest rate. And credit score is this, then this many is going to fail, and we're going to charge this interest rate. And they built the whole industry around that, and then nobody wanted to change it, even though the credit reporting software was found to need updates. They wouldn't update it. And so for 23 years I've been in the industry, we've heard and talked about, and they've even piloted new credit reporting software, but they haven't rolled it out. And it's because of this conundrum that the industry's in. That they have all these statistics about the old stuff, but they don't have any statistics for the new stuff, even though they've been piloting some of the new stuff. I guess it wasn't good enough. And so, anyway, when Pulte comes out and says, hey, we're going to start accepting this, my industry freaked out. Mostly the back end of the folks that don't talk to customers, they're the ones that mostly freaked out. But they've now pushed it out. They've been piloting a little bit more, and so Vantage Score 4.0 is now running at parallel. So we'll still pull the FICO scores, but no, we're also pulling Vantage Score 4.0. And so that means that's great and new, and who knows what it's going to bring. We'll see. But as of right now, we're using it for all our conventional loans and for our VA loans as well. And whatever the Vantage score is, we dropped 20 points, and we're going off of that mainly because, like I said, there's a lack of data. So they're trying to avoid getting, in there. They don't know how the credit scores compare. So anyway, it's kind of exciting, but going to the old school stuff, the stuff we've been using for 23 years, which still is very pertinent and frankly is going to also impact your Vantage score and all the others. Here's a quick credit hack. Okay. So number one, well, this isn't the hack. Number one, does it hurt to pull your credit? Guys, I can't tell you how dumb and irritated this little thing makes me. Credit Karma tells people they lose points, but Credit Karma is not a bank, at least not yet. And so, when they're going to start giving mortgage loans and stuff, then feel free to listen to whatever Credit Karma says. But if you're paying for Credit Karma, I don't know that that's important or necessary for the record. You can pull your own credit report every week for free from the free credit report bureaus, directly from the bureaus at annualcreditreport.com. So annualcreditreport.com, pull your credit. You can pull it. That won't give you the scores unless you pay for it, but it'll give you the data, right? And that's really all you actually need to know to make sure there's no identity theft and stuff like that going on. Well, anyway, coming back to what I'm saying, people are always asking, is it going to hurt my score if I pull my credit? And the answer is no, not in the mortgage world. Okay. But even if it did, who cares? It's not going to wreck your credit. It's just going to ding it a little bit. But it would only just ding it a little bit. Vantage 4.0 might. I don't know yet. We're going to find out. But the old FICO and the mortgage industry has been using for 20 plus years, it doesn't impact your score at all. I've pulled and repulled people's credit so many times that I know this, I've seen this. And so, number one, don't be afraid of that. If you're shopping around, don't be afraid of that. Also, if you didn't know, you're able to pull your credit in the mortgage industry as many times as you want in a 30-day period. It only counts as one hard inquiry anyway. Number two, if you're doing auto loans, you got 15 days for the exact same thing. So that's kind of cool. Um, what else? Oh, the credit hack. I want to tell you all about this credit hack. So this is probably the number one thing. So I stopped referring people to credit repair years and years ago because 99% of what people need to do was credit rebuilding. And frankly, there's not a lot of companies out there that can do it for you. And so I don't know of any. So if you're out there, call me. I'd love to just refer people to you. But what I tell people is you need three open revolving credit lines. You don't need more, but you do need three. And so if you don't have three, and if it's you and your spouse, you need three each. And so that can be three combined, like three joint accounts, that's fine. But you need three that are hitting your social security number. And those three need tiny little balances, balances that are closer to like 20 bucks. And I say 20 bucks for lots of reasons, but if you want the credit hack, I'm just going to keep it short right now, 20 bucks. You get a $20 balance on that new account or whatever your old account is, put 20 bucks on it, and you just recycle that month after month after month. Get like a Netflix, put your Netflix account on one of them or something like that, your Disney Plus on another or whatever different subscriber accounts you have like that. Just put them on each and then just pay them off once a month. You're fine. You're going to have impeccable credit score. But Josh, what about collections? What about charge-offs? What about bankruptcies? What about late payments? Yeah, those are bad. It's true. So let me go through each one real briefly. Late payments, you got to stop the bleeding. Everything I'm telling you doesn't matter if you're actively late on payments. Your credit's going to suck. That's just the way it's going to be. You've got to stay on top. How do you stay on top? We'll follow good financial planning principles. Number one, budget. Number two, figure out how to save money in that budget so you have more money left over. Number three, emergency funds. Number three, emergency funds. Every salary hourly person should have at least 3 months of their income in savings. If they don't have that, that should be your number one objective in life. Okay. Number four, insurances. These are four of the 7 steps to financial freedom I talk about in other videos. But if you have all the right insurances in your emergency fund, you are never going to have a late payment on your credit report. Oh no, Josh, I just forget to make my payments. Well, then set up auto pay, would you? My goodness. Come on, this is the whatever millennium we're in now. We got some advanced technology here. Use auto pay. You got the money in savings. There's no excuse. Okay, so if your payments were late, you just need to let it go. Just time will wipe it out. And it's kind of like having a glass of filthy, disgusting, crusty mud. You had mud and then you let it sit out in the hot sun and it's like rock. There ain't no way you're ever cleaning it. It's stained the glass. But if you take that and you run it under water, a faucet, you will be surprised how clean and how quickly that incredibly rocky, hard, glass that's nasty looking, how good it's actually going to look in the near future. So that's what you're doing by having the three accounts that are just repeatedly around the 20 bucks. Well, what if I owe more than my 20 bucks, right? What if I owe $2,000 or 5,000 and I can't pay it off? Wait your turn. I'll get there. I'm still explaining charge-offs and collections. So collections, most of the time the damage is done. When they hit your credit, the damage is done. If anything you do with a collection from that point forward is going to do additional damage to your credit, even if it's paying it. So the way I would handle that is if I had a collection, I would contact them and I would tell them I want this deleted. And the second that they agree to delete it, then I will pay it. But I will only pay it upon if I have the letter in my hand deleting it. Because they already damaged my credit. At that point, I'm a little bitter about it, frankly. Charge-offs. Charge-offs are done. They're not collecting. They're not, they just wrote it off. I've actually seen some charge-offs collect. And so don't ignore your calls if you're in trouble, had credit trouble in the past. Don't ignore it. Just talk to them, right? Just talk. Yes, they're going to try to twist your arm into getting payments, but no, stand your ground, know your budget, and even if you can just pay them $5 a month, I'm sure that's better than nothing for them, right? But don't pay any of it until you get a letter of deletion, because a charge off and a collection, when they hit your credit, the damage is done, and anything that you're going to do after that is going to exacerbate the damage. And so in that case, neither of them should get any payments from you at all ever until you have a letter of deletion in your hand. or they delete it and you can see it on that annualcreditreport.com. Okay, for you that asked about, oh, I owe so much on my credit already, I can't get it to $20 balance. Okay, I'm going to give you some really terrible financial advice, but some really good credit advice, credit score advice. Raise the limits. So the limit and the balance, that's what we're watching. And right now, you're probably like this, right? And so because you're so high, your score is probably terrible and you're having a hard time. But if they raise that limit, that has the same impact on your score as paying down the balance. So ideally, you do both. And then because you're separating it so much, that's going to pull you ahead on your credit score, which then gives you a little bit of momentum, a little bit of tailwind because maybe you have a 10% rate on your car loan because your credit was terrible. Well, if you go get your credit a little bit better, you can refinance that car maybe down to an 8% and save a few bucks, maybe down to a 7%, and so on and so forth. If you didn't know you could refinance cars, I sometimes wish I just did car loans. They can refinance you in a day. You can walk in and close and be done in a day, guys. It's pretty awesome. Some of them, different credit unions, different banks, shop around for sure. They vary a lot from institution to institution. Okay, I think that's all the credit stuff I wanted to talk about. So hopefully this has been useful to you so far. I want to finish up with a story. I'm going to take this part of my video and I'm going to turn it into a singular standalone video. And so forgive me for the introduction, but I'm going to talk as if this is just starting now. So let's see, how do I want to start this actually? Homeowners insurance, home warranties, HOA payments. Am I fully covered? Do I have everything I need to know in a house? The answer is probably not. There's at least one thing that sometimes will haunt my clients that I want to tell you about. And it's called, I don't even know if there's another company out there offering this service. So I'm going to use an actual brand that I am not affiliated with, but their name is Homeserve. There is a company out there called Homeserve that is offering insurance from the inside of your house to the connection with the city for both your sewer and water lines. But inside the house and everywhere else, you've got other things, home warrant, home warranties and homeowners insurance will often cover everything that goes on there. But from the connection across your front yard to the city, that connection, that piping is oftentimes not covered. Why? I don't know, but it is lame and is extremely expensive. This piping oftentimes gets 15 feet deep in the ground, which makes it extremely hard for a homeowner to take advantage or take care of it if it has a problem. Sewer lines, guys, and water lines. The sewer lines are off. Some of the old ones are made of clay and they have water in them. So guess what finds them over time? If you have trees and other, deep roots, they're looking for the moisture, that's coming from that. And so that actually creates a risk to plugging them and or breaking them. And so, especially in older homes, you generally want your sewer scoped before you purchase it, so you know what you're looking at. Some home inspections will do that, some won't. You'll have to ask for it if you want it, but once you've had it scoped, you may find that it's old clay piping, or you may find like one of my other buyers did that it actually was broken and the water and sewage and everything was just leaking into the ground and it had created a significant enough cavern that there was no backup or anything. They just, in fact, I'm not even sure how they found out, but they just told me that they found out and sent me pictures of them digging in the yard. Guys, the person I should show this picture. I'm actually going to see if I can find this. I'm not going to find that picture. Oh, that'd be so cool to be able to show that to you though. Anyway, so this client, they got in there and they found they looked like they were like this big. This is the ground above them, and they were down here digging, and there were these vertical walls that are like 12 feet tall of dirt. I don't know if you know this, but dirt can sometimes collapse and stuff, so it can be scary. Anyway, they got a bid to fix the job, and it was $15,000. And so Homeserve, last I checked, there's somewhere between 5 and 15 bucks that they charge people a month. And if ever anything like that goes wrong, then they can come in here and get it all fixed for you. And so, point of this video, take a moment, look into Homeserve, find if there's any other competitors out there at the time of this that you're watching this. See if you might want to have yourself even a little extra insurance in case any of that piping ever goes bad. The water coming into the house from the city and the water going out of the house to the sewer, both of those lines are typically not covered and they're extremely expensive to be able to do that much digging and replace them safely. So, that's what I wanted to share. So I hope that that's useful to you. And if you know anybody else needs to watch this, share this video with them. And anyone else that's dialed into this whole video, that's watching the whole thing now, I just wanted that's the last thing I wanted to cover today. So I just wanted to take the time to say thank you for tuning in. Thank you for the comments below and the sharing with this video and stuff with others. If you have anything in particular you'd like to know about or hear me talk about, or just interact with me, message below or shoot me an email or something like that, and we'll address it. So I'm a really small content creator. I don't have a huge subscriber base because I don't know if these videos are that interesting, mortgage videos in general. But I'm happy to address things. This has been life-changing for me to be able to work here. And as I mentioned, we're hiring others because I'd like to help other people have a great life too. So, okay. Have a great day. Thanks for your attention. Talk to you later.